Imagine turning a measly $1,600 loan into a $350 million empire before your 30th birthday. It sounds like a total hallucination, right? But in the 1970s, a legendary market wizard named Richard Dennis did exactly that. He didn't use insider information, and he didn't just get lucky. He engineered a systematic, rule-based approach that completely broke the financial world. But here is where the story gets wild. His multi-millionaire peers claimed that elite trading was an unteachable, innate genetic gift. Dennis disagreed. He bet his entire reputation on a radical thesis: discipline beats talent every single time. To prove it, he took a group of 23 ordinary people, musicians, chess players, bartenders, and handed them the keys to his exact system. They called them the Turtle Traders. The result? In just 5 years, this group of absolute beginners generated over $175 million in net profit. Now, if you're a retail trader trying to pass a funded account or catch consistent moves, you're probably asking the exact same question I did. What was the actual math behind this system? I spent hours digging through legacy market archives to reverse engineer his exact logic. And what I found completely flips modern trading psychology on its head. Dropping this breakdown took a lot of work, so smash the subscribe button and let's dive right into the mechanics. Before we touch a chart, you need to understand the psychological trap that destroys 95% of funded accounts. Most traders think they need a high win rate to be profitable. Dennis proved the exact opposite. You can lose 70% or even 80% of your trades and still make millions, as long as you master asymmetric risk to reward. His foundation was simple. Never risk more than 2% of your capital on a single trade. Cut your losses the second the premise invalidates and let your winners run for weeks. Look at this major resistance zone on the chart. Price tests it repeatedly, building up massive liquidity resting just above those highs. The amateur trader tries to predict a reversal. The system, however, waits for a definitive structural break. When that breakout candle closes, the trend explodes. By cutting the losing trades instantly and holding the single winning runner, your net payout completely wipes out the minor losses. It's pure mathematics over market emotion. Here is how you set this up step by step using modern charting tools. First, head over to your Indicators tab and look for the Highest High, Lowest Low channel tool. This tracks structural swing points. Go into the configuration settings and set the length to 20 periods, which is the exact short to medium-term cycle Dennis used to gauge market momentum. Remove the baseline moving average to keep your chart clean. This channel will now dynamically map out your key liquidity expansion zones on the 1-hour time frame. Next, we need a volatility filter. Search for the Average True Range, or ATR, and add it to your chart. Modify its length to 20 as well, and set the smoothing type to a Simple Moving Average. To make this foolproof, add a standard moving average directly inside the ATR indicator panel, also set to 20, to act as your volatility baseline. Finally, add a 200-period exponential moving average, or EMA, to your main chart. This acts as your structural filter. If price is trading strictly above the 200 EMA, you are only hunting bullish breakouts. Here is the exact execution blueprint. When price prints a clean candle close above the 20-period highest high channel while tracking above the 200 EMA, your entry is triggered right at the close of that candle. To calculate your invalidation point, check the current value of your ATR baseline. Multiply that number by 2. Subtract that amount from your entry price, and that is your exact hard stop loss. Yes, in choppy, consolidating markets, you might get stopped out a few times for a minor 1% loss. But look what happens when a legitimate high-volume expansion occurs. The stop loss is never breached. You ride the macro trend, and your exit trigger only occurs when price prints a structural break below the opposite side of the channel. In this case, the 20-period lowest low. For higher time frames, like the daily or weekly charts, Dennis shifted his channel parameters from 20 to 55 periods to avoid market noise and capture massive institutional swings. Richard Dennis proved that you don't need a complex, over-optimized algorithm to extract millions from the markets. You just need flawless risk management and the discipline to let the math do the heavy lifting. Drop a comment below if you're going to test this volatility breakout strategy on your watch lists this week, and I'll see you in the next breakdown.